Hello, it's Mark from Landmark Financial Services Group, and today we're going to talk about one of our tax planning ideas called tax loss harvesting. It may be a term that you've heard or read about in a journal or magazine. Don't have any idea what that is? Well, we're going to talk about it today. Now, tax loss harvesting is rooted in the notion that the stock market is down year to date, right? Our portfolios have come down. We don't like it when our portfolios come down. Nobody likes it. However, let's always think about the opportunities that might exist. This one is a tax planning idea. So how does it work? Let's say in your portfolio, you have lost money in some of the securities, and therefore you have what we call a built-in loss. That means that if you were to sell the security today, it would trigger a loss. Now, what's great is that loss can be used on your tax return. And the way it works is that we add up all of the capital losses, we subtract them from any gains that you have this year or capital gain distributions, and if there's still a loss after that, you get to use up to $3,000 against ordinary income. And if there's even more losses after that, we carry them forward indefinitely. Okay, so how does this work? You trigger these losses, that's why we call it tax loss harvesting, and it really does offset income for this year and maybe potentially for future years. The key to remember, there's two keys to remember. The first is that this only works for your taxable accounts. You cannot trigger a loss inside your IRA and use it on your tax return. Okay, that's an important point. The second is what we call the wash sales rule. And it simply says that you cannot sell a security today and buy the identical security back either 30 days before or 30 days after the sale. So let's say you bought Microsoft today, you sold Microsoft today at a loss. You cannot buy Microsoft within 30 days before or after that sale, and if you did, that loss that you triggered would not be eligible to be used on your tax return. Okay, that's called the wash sales rule. When we think about mutual funds, it's actually a little bit more of a benefit because it's possible that we could sell a large growth fund of one company and buy a large growth fund of a different company and be in similar positions, although not identical, within the 30-day period, and the sale would still trigger a loss that's used on your tax return. Okay, a little bit confusing, sometimes I get it, and that means if you have any questions about any of this, don't hesitate to call us because we're here to help. 978-984-5425. Thanks.